Hello, everyone. I hope you are all doing fantastic. It is the 9th of February 2026, and my name is Marcello Colax today without a video because I'm sitting here in a hotel lobby somewhere in Kuala Lumpur, trying to enjoy my weekend with my family. All right, everyone, I hope you are prepared for the next week ahead. We are expecting for the TTF to drop a little bit lower before bouncing. The German power markets are expected to simply move higher. EUAs don't have that much room to grow. We are expecting them to move just a little bit higher before continuing lower again. So overall, the European energy complex is all over the place this Monday morning, and it is not looking like a lot of fun. All right, of course, as always, everything you see here is not trading advice, and it is just my humble opinions and not an invitation to trading, of course. This is the TTF sentiment benchmark as we are publishing it this morning. You can see that the bulls are still in charge with 45%, which is no change from last week where the bulls were in charge with 47%. So here's the interesting thing. If we do have a bullish majority on the benchmark, but we see that the TTF front month is set up for a small decline this Monday morning, that could lead the bulls to freak out and close their long positions. We've had this twice this year already, once with a bullish case, the other time with a bearish case. So do be careful. Under reasonable circumstances, we would just expect a dip before the market continues higher on the TTF. But if the bulls really have no trust in eventual upside continuation, if that goes away really, really quickly, then we might see a much, much stronger decline this morning. But what are those levels, you might be wondering, and we'll talk about that in just a second. But first, if you are not already subscribed for some strange reason, then I highly recommend that you are signing up to the free Clever Markets newsletter that is published every Monday morning, 7 a.m. CET. You'll get the full video, you'll get a full TTF analysis, and you'll get a little bit more of off-the-cuff insights from me. My readers are telling me that this free newsletter is better than some of the paid stuff out there, so highly recommend that you're signing up. All right, let's have a look at the charts. So this is the TTF front month that we have in front of us right now. So let's start with the weekly chart real quick. So you can see after this stellar rise that we had just a couple of weeks ago, we have now bottomed out. We have tried to find some support near 31.27. It seems to be holding for now. Overall, we do expect the market in the long term to continue higher eventually, but we first need to move above the 37, which you can see is this old support that is now turning into a resistance. And it's also the high of this, well, let's call this a hammer. I'm not really sure if I want to call this a hammer because it didn't really form at the end of a downtrend, so be wary of that. But the idea remains the same. The bears tried to push lower. They couldn't hold on to their progress before we continued higher again. So that's why we're here. So overall, this is a bullish candle. But let's have a look at all the other tools. You can see that the momentum tools is still aligned with the bulls. Cool. We can see that the trend tools are aligned with the bulls. But what is this? We do have an oscillator that is showing us that the bulls might have run out of steam already. So this is the stochastic that we are looking at. You can see we didn't even make it into overbought territory. We are just topping out here somewhere neutratory near the 7T. So this overall could be a little bit of an iffy situation. And anyway, we're not deriving any trading decisions from the weekly chart. For that, we want to go onto the daily chart. So first things first, as you know, at Clever Markets, we have been working with our own in-house proprietary algorithms for over half a year now, and we've just released it to our clients. So what we are trying to introduce now is a more refined approach to trading decision making into the energy industry. So how do we do that? Well, first things first, we are looking at our algos. They are telling us what to do next. Is this a sideways market? Is this a trending market? How strongly is it trending? When do we know the market is more likely to turn? And these algos have been incredibly useful. They have picked out most, if not all, peaks and troughs this year so far. And also, before we officially released it, we were pretty much bang on with most big moves from most of the second half of last year. For the TTF front month, our algos are now showing us that the bull trend is not fully formed yet. We are weak into either direction. We are in a consolidation phase. This is dangerous. Trading opportunities for spec players are very, very limited overall. So don't expect any crazy big moves at the start of this week. We might be moving a tiny bit sideways. For the bulls to continue, we definitely need a move above 36.36. And you can see this is still our preference, considering that the stochastic has been moving higher. We have bottomed out here, but we are not seeing much on the MACD or on the trend tools in favor of the bulls. So here it is a little bit muted. The bears are definitely not in charge. Neither are the bulls right now. So we're really just waiting this out. With a daily close above 36.36, we could easily make it towards 40.5. If, however, the bulls fail to push through, the alternative is not immediate downside continuation. The alternative case, which I believe is just as likely, is a little bit of a sideways swing within 33.2 and 36.36 before we eventually maybe push a little bit lower towards the 31.30 area. And do you remember with our TTF sentiment benchmark being mostly bullish? So this is the bearish setup that we're actually dealing with. Here you can see on the TTF front month hourly chart, we have topped out. We did get, I mean, it is not quite a evening star candle pattern because this candle here didn't gap higher above this here and then below this one. But we do see even this here with a shooting star, we see that the market has topped out near an important resistance level. So what is that resistance level? It is this old head and shoulders pattern that was then resolved lower and then, according to textbook, very classically offers resistance. So this old neckline support offers resistance before the market continues. So why does this psychological level even exist? Why does this hold? Well, just imagine what's happening, right? So we have been bouncing and bouncing and bouncing 3 times. So as we are breaking here, there's going to be a lot of longs and shorts and those on the sidelines. Can you imagine? We are here. You are saying, hey, we have bounced once, twice, 3 times already. I'm sure we're going to bounce a fourth time, but then we break lower. So you are long in a market that is declining. So some traders might now be wondering, okay, so this is not going well, but at least I want to close this whole deal where I open. So at least I come out at a zero or near zero. That is the whole idea, right? So here, this is risk aversive behavior where they're trying to then close out once we hit the level again where they originally tried to buy. Can you imagine you're short, you are thinking, you know what? No, I think the market will break lower. And it indeed does, and it continues lower. Your fundamental view hasn't changed, but now we're exactly again at the price where you first thought that the market should go down. And here greed plays in, and you go, you know what? I'll just double down on this one. It was a good idea first time round, so I think I'll enter more shorts. And then those who are on the sidelines, they go, oh man, I missed out on this first big good move. But overall, I still believe that the market could and should move lower. So next time we are here, then is my chance to get some shorts going. So you can see, no matter if you're bullish, bearish, or neutral, this is the psychology why old support turns into resistance. And of course, the reverse case, if old resistance turns into support, we can talk through the entire case when it happens next time around. Isn't it cool? I hope this helps you explain technical analysis in a more psychological way and not just some crystal ball forecasting sort of rubbish that TA never was anyway. Okay, so let's get back to it. You can see the market is set up for a decline. We did get a reasonably bearish signal on the stochastic. We are not really going anywhere here, a little bit sideways, I want to say, but the bulls are definitely not in charge. On top of that, we are seeing that the momentum tool is giving us a bullish signal for the first time in a long time. And we also see that the 8 and 12 exponential moving averages are pointing higher. Okay, so what do we make of that? The bearish stochastic and the bearish candles near important resistance, first of all, means that the market could decline. Then the next question is this decline just a correction before we continue higher? Or is it going to be like a full-on downtrend? Well, for now, it's looking to be more just a correction. And that is because the momentum is still bullish. Okay. Bearish stochastic indicates a immediate peak. Is this going to be a correction or reversal? Well, let's look at the momentum. Momentum is still bullish, more likely to be just a correction. How low can it go? Well, we just look at the most recent trough. This could be here, the 34.1, or honestly, maybe even this one here, the 33.49, right? If we bounce here, then we could easily retest this area again. And what happens beyond this place is pretty much unknown. So if we push above the 36.76, then the bulls could continue higher. This would be in line with the daily charts bullish assessment, but there is no guarantees. And please be aware of this sideways neutral trend within 33.2 and 36.36, which would then simply mean the market swinging sideways in this really wide range on the hourly chart. All right, that is it for the TTF front month. Let's have a look at the German power markets. I just want to spend 1 second on the weekly chart where we see that the market has been moving into this increasingly tighter range for a very, very long time. So overall, on the weekly chart, we are neutral and we are caught within this range of 81.85 and 87.75. Right now, like in the long medium short term, we are expecting the market to bounce near 81.85 in the next couple of weeks, move higher again. The alternative scenario is simply a break lower. This would be unusual because that would kick off a full-on bear trend. However, if you're familiar with technical analysis, you might recognize this ascending triangle as a typically bullish pattern. So overall, if we push above the 87.75, then the bulls will simply continue because it is a bullish pattern overall. Right now, doesn't look like it. So the alternative is to break lower. Now, how do we trade this, if at all? Let's have a look at the daily chart. You can see it is tricky, okay? Between 81.66 and 83.55, we have to make a decision. We are at the key support level of the 200-day exponential moving average. We are at this ascending triangle support. We have formed a bullish hammer candle. And what is the stochastic doing? It is giving us a preliminary bullish signal with percent %K crossing above percent %D, white line crossing above the orange line in oversold territory. This in itself is not a bullish signal. The bullish signal would only be given above the 20 mark, above oversold territory. Not happening yet, but we are careful. We are careful. The whole candle happened on reasonably high volume as well. So the market is ready for a bounce, right? So what we do is we mark out the support and the resistance levels. If we give it a push above 83.5, then we could easily make it towards 87.7 with 86.59 as a pit stop in between. Because above this level, the bullish hammer candle would be validated. The bullish hammer candle would be invalidated if we push below 81.66, which would also mean the move below the ascending triangle, and then the whole bullish setup, both in the very short term and also in the medium term, would be undone. If you're an existing client, then this will be super interesting for you. So go to the knowledge base on our dashboard, go to the candle pattern glossary. Of course, the pattern will already be highlighted in the text itself. Then we want to go to glossary, and we kind of want to have a look what a shoot. No, what are we talking about? A hammer. What is the success rate of a hammer? So here's the thing: we have back tested all hammer candles across key European energy markets, both for the hourly and the daily chart. And the result is that the success rate of this pattern is just under 50%. So just because the candle pattern formed doesn't mean that it is most likely to also resolve higher. All that these candle patterns are doing is they're giving us a heads up of that something could happen, but we are still at nearly worse off than a coin toss. If you want to actually elevate technical analysis to the next level, combine it with algos, combine it with real statistics, if you want to move away from legacy newsletter that haven't changed for the past 25 years, start working with us, Clever Markets, check us out, get in touch on the website. You and your team probably deserve better. Now, let's have a look at the German Power hourly chart, the German Power Hour. Okay, so you can see here we are still prepared to move higher immediately. This is very different to the TTF where you first expect a dip, okay? So why do we expect this? Well, first of all, we do have some bearish reversal candles here, right? We do have a shooting star, we have a hanging man, kinda, which all looks a little bit bearish to me in theory. But is this confirmed by anything else? Well, the first question is, are these candle patterns forming near an important resistance level? Not really. The next important resistance level is near 84.5. Okay, did these candle patterns happen on high volume? Also, no. In fact, it happened on declining volume. Yes, okay, these were the last 2 hours of last week, so the volume is expected to be lower. But hey, volume is still declining. Are we getting any new bearish oscillator signal? No. If anything at all, we are still having room to move higher. So, all things considered, there is no indication that these bearish candle patterns would actually lead to a decline. So that's why we believe that the preferred scenario is a move above 83.5. Here, once again, we have to wait for confirmation for it to actually happen. And then we can move towards 84.67, which is on the German power hourly chart the lower end of this, which could have been like a rectangle or a descending triangle, but it's a important resistance level that was previously support. Now, what is the alternative? Well, the alternative is a little bit of a sideways move. Here, we are probably looking at the range of 81.86 and 83.5. And anything within here will be difficult to trade on the hourly chart. So if you must go on the 15-minute chart, if you can wait it out, some traders might be looking for the broader trend. For example, here we do have the descending triangle target near 80.1. All right, that is all for the German power front year. All right, and the last market we are looking at today is the EUAs, the European Carbon Emission Certificates. But before I go there, here just a quick reminder, I hope I will be seeing you this May, either in Athens at the X Energy Exchanges conference or at Flame in Amsterdam. I'll be hosting a Clever Markets technical analysis masterclass that teaches you everything you need to know to survive this year. Volatility is not going to go away. The markets are not going to get any easier. Trends will remain short. And yes, the hedge funds and the portfolio managers, they are still continue to mostly just look at technical analysis. And we would know that because you're advising probably quite a lot of them. So if you want to know what your industry peers are up to this year, if you want to know how they are trying to generate P&L, if you're a physical trader and you're looking to really make some good buying decisions this year for your clients and for your team, then I highly recommend that you join. Just go to the respective websites. When you book your tickets there, there's always an option to add the Clever Markets Technical Analysis Masterclass. All right, now let's have a look at the UAs. Here on the weekly chart, we are within the super wide channel that has been in existence since February 2024. We have recently, over the past 3 weeks, come off quite a bit, and you can see here we are expecting the market to decline further towards the low 70s area. This is nothing crazy. Volume is high. We are not getting any sort of bullish signal on the stochastic. We are seeing that the MACD has topped out as well. So we do believe that the market could go quite a bit further. Now, on the daily chart, of course, that is where we start making decisions, not on the weekly chart. Here we are also seeing more or less the same. We see that the momentum is well below zero. This is the MACD, by the way. So here bearishness is expected to continue. We're looking at the DMI/ADX indicator. We see that this white line, the ADX, is near 32, which means the market is strongly trending. We are seeing that the red line is far above the green line and still pointing higher, which means that the bears are in charge. We are not getting any sort of bullish signal on the stochastic, so we are good to go here as well. We are seeing also that the 8 and 12 exponential moving averages are pointing lower. So yes, we do expect the market to continue lower at the start of this week. Now here's the thing. Sometimes this doesn't work out. So at what point would we know that the downside is not going to continue? Well, for that, we put on these FIB retracement levels. We put the 0 down here on the 6th of February, and we put the 100 up here from the 22nd of January. Here is the 23.6% FIB retracement at 79.65. This is our first resistance level. If we were to break above this, which we don't believe is very likely, then we could make it towards the 61.8% FIB retracement at 85.24. If we make it here, then the market should top out and continue lower afterwards. If it does, then the bear trend will simply continue. If we make it above this, then the bulls will continue. It doesn't seem super likely right now. So here, once again, we see this kind of hammer candle, but not really because the upper wick is too long. But hey, the idea remains the same, even if it doesn't fit the textbook criteria, right? The bears try to push lower. They try to continue lower after this big red candle, but they quite couldn't. And we ended up where we started on a Friday. But still, this bullish candle not looking very bullish to us. We think that the market could continue lower. Now, here's the thing. We are not going to go lower in just a straight line. As you know, it's always going to be a zigzag. So in order to trade that, we look at the hourly chart. So here you can see last week on the 5th of February, we moved below this rectangle that has held quite nicely, right? Support, resistance was all good. At some point, we couldn't hold on. At some point, we failed to hit the upper end of this rectangle. So, and if you've been with Colava markets for quite some time, then you know what that means. If at some point we no longer hit one area or one side of a pattern, then this whole thing is more likely to resolve to the other side. That's exactly what happened now. We did almost go to the rectangle downside target near 75.13. I mean, not quite. We still got some room to decline eventually. But right now, we have bounced on the 6th. We are continuing a little bit higher. Once again, we're working with Fibonacci retracement levels with the 100 up here at 83.5 and the 0 down here at 76.2. We have moved higher. We are at a 38.2% Fib retracement. You can see we already made it above it. So this morning, we might be making it to the 61.8% Fib retracement at 80.71 before we find resistance and maybe continue lower. Why do we think that eventual downside continuation is most likely? Well, that's simply, once again, because the MACD in the preceding down leg was also bearish. Down leg, bearish MACD, the bears were still in charge. So overall, this year is expected to be an upside correction before we continue lower. And you can see overall, this would also be fully in line with the daily charts expectations of eventual downside continuation. All right, I hope you all found that useful. You got some value out of this Monday's energy market video. My name is still Marcello Colax. I hope you're all having a great week ahead. See you around and bye-bye.